Good afternoon, everybody. Welcome to the TI Apply and IU uh, freight rate benchmark for Q1 2025. Thank you very much for joining us. It's a pleasure to have you with us once again. And I think today is going to be an especially interesting webinar because there's so much to talk about, so many different trends and developments taking place within the global logistics industry. And obviously, they all feed into the European market and obviously each have their effect on rates. And we're going to try and shed as much light as we possibly can on those events today and what they actually mean when you take them through, first, second order into their implications for road freight. So it should be a very exciting session today as well. And I think you'll probably already have noticed that we've had a bit of a refresh of the webinar presentation. So we've updated this again, and there's also a few changes in the flow of the session today as well, which will allow us really to highlight a few things. Firstly, more of the domestic rates that Apply is able to provide in the analysis here. We've also got some more space for insights from IU as well. And at the end, we'll be doing an analysis of the sentiment poll that we've been running through these webinars over the last couple of years. And we'll be asking you again for your own views as to how you think freight rates will be developing in the next quarter. And like always, it's especially interesting this time with all of the ups and downs. So we'll be very interested to hear what you think on that side of things as well. So please be prepared to answer that poll at the end. Please also bear in mind that you're able to ask any questions that come up through the webinar. So just ask those using the Q&A app, and we'll deal with as many as we possibly can at the end. We have the panelists, of course, but also a team of very hardworking colleagues behind the scenes to answer as many questions as possible. Okay, so I am your host today. My name is Michael Clover, and I'm TI's Head of Commercial Development. And I'm very pleased to be taking you through the trends in today's webinar again. I'm also joined by my colleague Nathan Donaldson, Economic Analyst and our data team lead here at Transport Intelligence. So welcome, Nathan. Thanks for joining.
Thank you, Michael. Hello, everyone.
And for those of you that don't know TI, we're a provider of strategic market intelligence for the logistics industry. So always very, very happy to talk about trends in road freight, but also in other logistics and supply chain matters. I'm also joined, as always, by Thomas Lariou, Chief Executive Officer of Apply. So welcome, Thomas. Thanks for joining us again.
Hi, hello, everyone.
And would you just like to give a quick introduction to Apply for those who don't know you?
Yes, Apply is a transport management platform that we created some years ago now. We're giving a lot of services and providing a lot of services to shippers and carriers. One of these services is to access to market data and market intelligence. And this is exactly the data that we will see today, data that are directly coming from our clients, shippers, and freight forwarders.
Brilliant, thank you. And finally, I'm also joined by Marianne Savoni, who is joining us from IU and is the Associate Director of Strategy and Intelligence at IU. And welcome, Marianne. Would you like to introduce IU for those that don't know you?
Yeah, sure. So good afternoon to all. So IU is the World Road Transport Organization. So basically, it means that we represent commercial road transport sector globally, not only in Europe, but in all the different regions. I have to say that we count a large diversity of members and partners. So we have national road transport associations, if you want. We also have logistics companies, big players. We also have shippers, service providers, banks as well. So what do we do to make it simple? We advocate as IU. We advocate at regional. We also advocate at global levels, notably at UN. We manage and we develop solutions to also facilitate the international transports. And also we develop intelligent services. And you will see today some of our different analysis. So we do regulatory monitoring, fuel prices by type of energy, decarbonization intelligence, driver shortage. So all the data I will present are published on our intelligence platform. And if you are not an IU member or an IU partner and you want to access the information, you can definitely subscribe to our intelligence services. Thank you, Michael.
Brilliant. Thanks, Marianne. Yes, and a couple of bits of housekeeping just before I move on to the methodology, and we can explain where the data comes from that I need to do. So firstly, I must read this disclaimer. So we remind you that all discussions and statements made by participants on commercially or strategically sensitive information may fall within the scope of competition law and be considered as unlawful. We invite you to refrain from sharing any information of such nature or entering into any such discussion, including during breaks. And in addition to that, I should just also mention that everyone will be sent a recording of this session and the report as well alongside this at the end. So please, you be aware that you'll be in receipt of the recording and materials after the session. Okay, so next slide is just the background methodology to help you understand the data that we're going to be talking about today. And as all the data comes from Apply, it would be great if Thomas, you could just take us through the methodology, please.
Yes, so all the data regarding market rates that you will see today in this webinar and later on the reports that you will receive are directly coming from what we call transactional transport prices. At Apply, we are working both for shippers and freight forwarders, providing some freight exchanges, some tools to automated procurement for road transportation. And so we are collecting this data. And today, the focus that we will do is mainly, is only on FTL full truckload data. For general cargo, we will have spot and contractual prices. Fuel is included. You will have also a huge part regarding the cost evolution of fuel and other type of calibration of fuel. So this is the focus of today. If you are interested by more data regarding reefer, regarding bulk, regarding LTL or others, we do have also this granularity at Apply. We just decided today to focus on this one during this webinar. So feel free to come see us if you have more precise questions. And on the right part of the screen, you see here the coverage that we have regarding the data, a heat map of the darker places where we have the more data. And this is these places and these countries that we will see during the webinar.
Great, thank you. All right, well, let's dive into the actual data then. And we'll start off, as always, with our overall European benchmark. And here we see the trend. So looking like both indexes are slightly down this quarter. But Nathan, could you just take us through this, please?
Yeah, sure. Thank you, Michael. So yeah, as you mentioned, we've got both indexes that have fallen, meaning the cost of road freight in Europe has broadly fallen across the board in the first quarter 2025. We focus first of all on the contract index. Now that's fallen to 131.1 in quarter 1 25, and that's 5 index points below its peak back in quarter 3 2022. And we've got a quarter-on-quarter fall of 2.3 points. Now that's actually the largest quarter-on-quarter fall for this index since quarter 3 2023. So that's a year and a half. And year on year, the index is actually slightly up 0.4 points. Over on the spot index, we have it reaching 134.1. Now that's down 3.5 points quarter on quarter and up 1.6 points year on year. And if we just compare the two as well, before we just review the indicators, well, the gap between the contract and spot indexes has actually narrowed to 3 points, and that's down from 4.4 points in the previous quarter. And that's largely driven by that larger fall in the spot market, which is a combination of factors we'll get into in a moment. So onto the overall market story that we're seeing. So first of all, we've got this quarter one, which follows a peak period. So we're seeing that expected seasonal drop off in volumes. So that's pulled the demand pressure down on rates. It means that it's affected both markets. We've also got the story that Marianne will go into a bit more, which is the costs. So we're seeing less cost pressure in the market. The tightness has reduced somewhat. So we've now got the ability for falls that we didn't have over quite a significant period of time as costs have been increasing. And that cost pressure and that cost base has just been significant and consistent. If we talk about what we're seeing in terms of the demand environment, well, we've got a largely stagnant demand environment within Europe. If we look at the consumer spending, Now that's up 0.6% quarter on quarter, that's seasonally adjusted, but it means that the pressure coming from especially consumer and retail goods is largely flat. And if we're looking at the actual behaviors of consumers, well, we've got 61%, so a majority of households are trading down, and 74% are either trading down or buying cheaper alternatives. So we're still seeing that minimal pressure from the consumer side. Now, the manufacturing, of course, is a very different story. And then we then have the story of the tariffs. So we've got a lot of uncertainty in the market at the moment from the tariffs, especially in the spot market. It's discouraging large pressure on the production side. And we've got Germany, which we'll talk about a lot more, which we're still seeing reduce pressure, especially from that production side and low levels of new orders. Then just to look at the outlook then, I mean, the outlook really dependent on what we see in the future, and we're existing with a lot of uncertainty here. But we have seen receding inflationary pressure, and it depends what happens to consumption as a result. So will this mean that we'll see some wage growth and we'll see consumer spending rise? Well, likely we won't see it pulling down and reducing the pressure, but we will see to what extent that will add pressure and potentially push rates up as we head into 2025. Now, economic activity is expecting to increase somewhat, 0.2% for Europe. Private consumption is expected to
Nathan, I think we seem to have lost you for a second there. But I think you were just rounding off the analysis there on the expectations for the year ahead, really looking at consumption levels. And it is a very interesting story on the expectations for looking to the rest of 25. Oh, Nathan, you're back. We lost you for a second there. To carry on.
Okay. So yeah, generally through to 2027, we'll see minimal upwards pressure. And then there's some potential for some pressures to move from the contract market to the spot market as that uncertainty around the long-term values remains.
Okay, I think we'll have to move on from
side. So there could be some increases, but we remain in a place where there's some falls that are possible as well with the uncertainty and the continued slow growth in the European economy.
All right, thank you, Nathan. Yes, a very uncertain picture, really, as we look ahead, but hopefully we can shed some more light on that with the outlook a bit later on. Okay, so that's the overall European picture. We'll now move on to look at underlying volume development expectations. And we're going to use some data from IU here, and Marianne's going to explain the trend and the expectation for the next couple of years here as well.
Yeah, sure. So I have to say that it is the first time that we show this picture of the freight volume. So you can see on the graph basically is the historical evolution of the road freight volume in trillion ton kilometer from 2020 to have the history until 2024, and we give an estimation of the road freight volume forecast until 2026. And just to mention here, the measure we take is ton kilometer, because we believe that it reflects the most the transport intensity of the road transport. Tons here serves as a proxy, so for the weight, and the kilometers are giving us or representing the distance. So you can see that in 2023, as you all know, the volumes fell slightly, reaching 1.86 trillion ton kilometer, which is 3% less than in 2022, and recovering in 2023. And just few elements of analysis. 2/3 of the total EU road freight you can see here are transported nationally. However, some countries heavily rely on the international transportation or the cross-border goods transportation. And this is the case of Lithuania, as you may all know, which is representing more than 90% of the total freight volume. And in the case of Spain and Poland, it is very specific here because they are expanding not only their domestic, but also their international road freight volume that are reflecting, in fact, their robust local demand and also the competitiveness of the transport prices. So if you look a little bit forward, the road freight activity in the EU is forecasted to show modest recovery in 2025, and which is notably supported by the steady industrial output and also an improving producer sentiment in Q1. And if I take the Eurostat data, the inflation is continuing to give weak level, notably, easing to 2.5% if I take the information for March 2025. And additionally, you have the industry sentiment, which is improving, and you have the producer confidence index that is improving notably from -11 in January, going to -7 in March. And very important here, the industrial production is also rebounding. And this is also important to understand that we are a little bit reaching the 2021 baseline. And this is notably driven by the manufacturing industry recovering. So in the medium term, the trend is confirming the dynamics. So we have a real GDP, which is going to reach or grow by 0.2% during the first 3 coming quarters. And this is notably Spain and Italy that are driving the growth. So this is important to mention it here. So this rebound I am mentioning is reflected in the road freight volume you can see on the graph. And it has started to pick up again across the major corridors. You will hear it with the detail by itinerary. But this is the case for, if you take Germany, France, or Spain, France, or Germany, Poland. But we need to be cautious here. This broader picture of this potential recovery has to be, looked at with a lot of attention, because you have the tariff uncertainties we are going to speak about. You have also the policy disruptions that can have an impact on the trade flows and also on the rates. Anyway, if you want to know more on these assumptions and the different analysis behind, you can go to our intelligence briefing and go through the different analysis we have done. We have published it, I think, few weeks ago now. Thank you, Michael.
Thanks, Marianne. Yes, and there's also some more insights in the report on lanes as well.
Absolutely.
So that's the demand side picture there. So marginal growth really predicted, but we'll now move on to looking at the supply side, and firstly looking at costs with diesel prices. So Marianne, would you take us through this, please?
Yeah, absolutely. So here as well, we have changed a little bit. If you are used to attend the webinar or to also download the report, we were used to put a lot of countries. We decided this time to really focus on the main ones that are also tackled in the corridors detail after that. So France, Germany, Italy, Poland, and Spain are presented here on the graph. This is the index of the diesel prices at pump. Diesel prices at pump say they reach an average of 1.6 euro per liter in Q1. We can say that diesel prices have increased by 5% quarter on quarter, but they are really decreasing lately as the trade situation is bringing a lot of uncertainty to business. So this is having the impact to slow down the global demand for oil. And if I take the Brent on quarter, the Brent rose by 1%, what was largely due to a sharp increase until mid-January, and then seeing a slow decline. So again, if we want to forecast, it's very difficult for the fuel prices. It's a difficult exercise, notably in the context that we know with the trade tariffs that can have an impact in both ways. What we can say is that already at the end of April, the Brent reached about $64. So this is a 13% decrease month on month. And the American Energy Information Administration is forecasting a Brent at the end of the year around $68, so which is a minus 16% decrease year on year. Just to finish on the prices, we'll mention one element on the HVO prices, because this is something also that you will find in the report that we will publish just after the webinar. HVO prices are seeing the same trend than diesel on a quarter basis. You know that this biofuel is 5 to 10% more expensive than diesel. So to give you an idea, it is reaching 1.93 euro per liter. And of course, at the exception of Italy, which is showing a lower price because there is a more favorable taxation, which is allowing the price, which is about 1.88 euro per liter. So The same, if you want to know more information, we have the detail of fuel prices on the intelligent platform with the detail by energy. So HVO, CNG, LNG, and also, of course, diesel. Thank you, Michael.
Okay, brilliant. And the next aspect we're going to look at is driver shortages and the impact on the market and on labour costs. So here's the latest data. Would you take us through the changes?
Yeah, so this is the latest data indeed that we have published a few weeks ago now. So this is the map showing you the truck driver shortage for the different European countries where we have done the analysis. So definitely the shortage remains high. You can see that it's about more than 400,000 unfilled truck driver jobs in Europe, according to our last survey, which is representing about 12% of the shortage. So if you can see, you have the colors are showing the different levels of shortage. And you can see that Slovakia has the highest share of unfit truck driver positions. You have, a driver shortage of close to 20%, which is equivalent to about 13,000 positions, followed by Estonia, Poland, and Czechia also. So basically, you can see that the countries having the highest shortage are really the Eastern countries that are highly depending or was very depending on the third country drivers, especially those that left following the start of the war in Ukraine. And just to give you an idea, before the war in Ukraine, it was close to 200,000 truck drivers from Ukraine, Belarus, and Russia that were working in Poland, Lithuania, or Estonia. So this is the main explanation around notably this high shortage for those countries. Another element I want to mention here, the smaller companies are facing the higher difficulty to fill in the positions. 3% of truck drivers are women, according to the reports, and 4% are under 25 years old. So very important here, it means that with this very low number of young drivers, in 5 years, you will have a significant proportion of drivers that will retire. And this is a very big, I would say, a very big issue that we are a lot communicating within IRU, because if you take the sum of all the drivers that will retire in 2029 or 2030, 5 years time, it's about 600,000 truck drivers that will retire. And this is notably due to the fact that 1/3 of the truck driver population is more than 55 years old. So this is just to give you some key figures. There is one question I will answer live, notably on the main barriers around it, notably the access to the profession, but also the low level of attractiveness of the profession. So I can give more detail during this my answer to this question. Just to finish on that, more on the political side, you had a lot of developments at the European level, and there was an agreement between the European Commission, the European Council, and the European Parliament to harmonize the minimum age for professional truck drivers to 18 years old, but also to open the possibility to start the qualification training at already 17 years old. And finally, this agreement is also paving the way for carriers to more easily hire non-EU drivers, so to increase or to fill in the gap I just mentioned now. So it means here to recognize, to create the framework of recognition of the qualification of drivers coming from non-European countries. I will stop here, but I can give more detail after during the question.
Thanks, Marianne. Yes, very, very interesting. And it is that sort of ticking time bomb or demographic time bomb in the refugee we worry about. Yeah. Okay, and then on tolls, this summarizes some of the recent changes.
I will be brief on this one. The map that you can see is showing the latest tolling prices trends in 25 versus 24 that we monitor in IRU. So we consider here the tolls prices evolution as a whole. So it includes here the CO2 toll taxation impacts. So the colors are showing the prices decrease trend in green, the increase in yellow, and the light blue is showing no recent changes in terms of prices. So basically, what you can see is that the Q1 is showing an increase of the tolls prices in a lot of countries: Bulgaria, Spain, Italy, Poland, Netherlands, Denmark, Sweden, and the tolls increase range from 2% in Italy to even 20% in Bulgaria on a year-on-year comparison. And on Denmark, it is mainly due to the fact that they have changed in January their tolling scheme, and they are now applying for the digital distance-based fee instead of a time-based fee. Meaning that now they were, and they are not anymore, but they were the last country to become compliant with the revision. And finally, the Netherlands, Luxembourg, Sweden applied at the end of March, so at the end of the Q1, the CO2 component for their time-based fee, and which is raising the prices by 2%, for example, for Euro 6 Class 1 articulated vehicle for those countries. These three countries, to finish, are preparing to move forward with the digital distance-based fee calculation that we can expect in 2026. I will stop here on this one.
Okay. Thank you. Yes, so the cost situation with fuel prices generally coming down, but there's still some cost pressure from other cost factors as well to include. But generally, we're seeing a slightly cooler situation. But in terms of the actual rates then, I think it's time we turn to those. We're going to start off here by showing the domestic rates, both in contract and spot. But this first chart is focusing on contract rates for domestic markets. And Thomas is going to explain some of the key trends here for us.
Yes, I will first start by explaining how this graph is built. You see here an index, so base 100, what you see in January 2017. This is a month-to-month index, so it's also to take into account compared to a quarterly index. We see here the price for March 2025 compared to January 2025. And so what we see, globally speaking, so contract rates for four main countries, France, Germany, Italy, and Spain, meaning that for each country, we take an average basket of the top cities within the country, the top logistic cities, and we keep this weighted average as a base for our index. So this is how the index is built. You will see that also for different pairs countries or cities. Here, what we can see first is that if we look at the contract evolution, the rates are quite stable for many countries. If we look at France, Italy, or Spain, we will put France and Italy in the same basket, where it slightly decreased over the past quarter, while Spain is still increasing slightly once again. The first analysis on that, if we look at the global economic growth, is that Spain it was previously quite strong country in terms of GDP in Europe, the top one in the past quarters. It still is. If we look at it has an industrial demand that rose over the past quarter, especially in the automotive and the motor vehicle sales, where it's plus 3.3% year on year. So still very active industry, which is what is pushing over the demand for transportation within Spain. Once again, we are talking about domestic contract rates over there. Regarding, I'll talk about Spain, France, Italy. Now, if we're looking at Germany, there is more up and downs on the Germany index that we can see here. We need to look at it also at the general level, where we had a peak over the end of the last year that were mainly due to the high season peak, and we saw that also in the general German consumption of goods. I think we can see that this high peak is corrected by lower contract rates right now. So we need to be cautious on this data also, and to see more that over the past quarters, if we take an average, we are at the Germany level on a slight decrease of contract rates, mainly due, if we are looking here at the general economy of Germany due to a low demand industry that is still struggling, and the tariffs that have been put in place by the US, the USA are still quite debating, because we don't know if there are tariffs or not, or for how long. But still, tariffs were on the automotive part, on steel, on many part of the industries where Germany is very strong. So the impact that we get from these tariffs is quite strong on Germany, as we see it from general economic studies.
Yeah. Yes, thank you. I think it's a very interesting point about the effect on different markets there of those tariffs on demand. All right, so we've looked at contract rates. Now we're going to take a look at spot, and Nathan's just going to take us through some of the key trends shown in this data, but all for the same countries.
Thank you, Michael. Yep, hopefully I can stay with you this time. So I think I'll pick out two of the interesting stories that we see that definitely shout out to me here. So again, we've got Germany, which we're seeing is quite an interesting story across the board. So German domestic spot rates dropped sharply to 122.4 in February, and that's largely affected by those tariff announcements. And that's if we're looking at the changes quarter on quarter, we've got them down 4.2 points, and then year on year they're down 6.8 points. So this is looking at Germany. We look over at Spain, which I think is also the other quite interesting story here. Is it's one of the few to see a month-on-month rise, and that's actually 2 month-on-month rises in the first quarter of the year. So that's in January and in March. If we look at the quarter-on-quarter changes, domestic Spanish spot rates are down 2.6 points, but they're up a big 14.4 year on year. Sorry. So if we're looking at the market story, I mean, it's the market story that we've covered already largely in Germany, but it's a situation of a combination of that demand and that cost story. So we've got weak German manufacturing. If we look at the PMI, it's at 48.3. So anything below 50 suggests contraction. So that's consistent contraction in the German economy. And then if we couple this with the tariff announcements, it's really hurting the orders, it's really hurting the demand, and it's affecting that uncertainty both inwardly and outwardly in the German market. So we're seeing less pressure and less demand for goods, both for inputs and for outputs for German manufacturing. And then in terms of consumption, the German consumption remains quite a quiet story there. So very little pressure on the rates. But then, of course, we've got costs. So we've got less pressure from costs, and then we've also got some falling fuel prices. So then that's allowed these further drops in the German rates. If we look over at Spain, the market story, well, Spain continues to be the shining light of Europe, really. So Spanish economy that outperformed the European economy, growing at 3.2%. And that's driven by factors across the board: consumption, production, tourism. So we've got demand for goods coming and affecting across the board in Spain. And they're also gaining in terms of a resilient consumer base, but then also benefiting from improved competitiveness against the rest of the world, which has been helping their production. So demanding inputs, producing more outputs, and adding more pressure, rate pressure and demand side pressure to the rates. In terms of an outlook, well, we're looking at kind of a more gradual recovery. The Spanish market is likely going to continue to have some upward pressures. So we're going to see it's less likely to have drops than the other markets are. The German market, well, that's a really uncertain situation. We're still waiting for that recovery to happen there. The consumption is adding very little pressure. But one thing that I mentioned in the outlook before is the potential for this uncertainty to actually encourage and add a bit more pressure to the spot market, as sometimes as companies tend to want to stay more flexible with their demand for road freight and avoid the contract market. But largely downward pressure from costs and very little demand side pressure, but downward pressure in the German market can provide some more falls. Spain is likely going to see continued upward pressure and some rate rises, but there's some volatility there that it shares with the rest of Europe.
Thank you, Nathan. Yes, it's very interesting. I think when we wrote the report, we would have expected maybe there to be spot market pressure on rates from product dumping of Chinese goods into Europe. Now we see tariffs on China from the US maybe there'll be less demand coming down. Sorry, maybe there'll be less demand for that kind of spot freight, but so uncertain, really difficult to say at the moment. But we'll anyway move on to international lanes. We'll follow the same format here. So obviously not picking out specific countries here, looking at some of the key lanes, which will be familiar to you. And Thomas is going to take us through the highlights here as well.
Yeah, thank you for the introduction. So this is exactly the idea, to look here at some city pairs that will represent, let's say, country to country. I will start first by answering one live question that we received. Indeed, you need to take into account that here in the global rates, the cost of transportation, the fuel is included, meaning that it's explaining also, and we have seen previously with the slide of Marianne, that the cost of fuel decreased over the past weeks, over the past quarter. So if we look at the past quarter, globally speaking, the cost of fuel at the beginning of the quarter in January and February was quite high. Over the past weeks, it decreases, but it can explain that decrease of price. Still, we can see that in certain countries, and it was the case in Spain, for instance, the cost of transportation increased globally speaking. So the fuel surcharge or the fuel cost is not only the one that is explaining everything. We need to take into account both offer and demand. Here, the global view on that is first insight is, if we are looking at the according to the Standard & Poor's index, we see an increase in the industrial production in Europe, and this was not the case for over 2.5 years now. So the manufacturing production was standing at 48.6, while it was 37.6 at the previous month. So we have, globally speaking, an increase in production. Still, we have a consumer demand that is quite weak at the beginning of the year. This is often the case. We have the peak of the Christmas season, and then the demand for clothes, for food, for different household demand is quite weak. This is still the case over the first quarter. And let's say that the industrial demand is not quite balancing this part. This is why we see a quite stable and decreasing rates for almost all the corridors over there. Try to look at the outlook. So for sure, you have in the report that you will receive, you will have a detailed analysis for each of the corridors. So please have a look at that if you want to have a look at your specific corridor. I will try to go quite quickly on the outlook right now. The impact of the geopolitical issues right now and the tariffs, globally speaking, between the US, China, and else, have a great. It's quite difficult to forecast exactly what will happen. What we see already is that nearshoring actions that was starting just after the COVID to try to produce on friendly countries or on closer country is still active. We see that at the industrial level within Europe, and this might have also an impact, a quite positive impact, on the local demand between countries within Europe. So we need to follow that, because still the demand is not here, and the forecast for the year 2025 is that it will remain quite stable. But maybe we can have the good part of these tariffs will be to have a nearshoring production that is more active, and so have a positive impact on the demand of transportation.
Yes, thank you. Okay, well, let's have a look at the spot rates then for these international lanes, and Nathan's going to take us through the trend here.
Thank you, Michael. So I think to pull out 3 interesting stories from this auction. We have Lyon to Birmingham, first of all, which is down 4.1 points quarter on quarter, to 150.3, or €2.31 per kilometre. And that's down 16.8 points year on year. So significant drop. If we look at Madrid to Paris, we see that it's actually climbed 4.8 points quarter on quarter, up to 138.5 points, and that has it up 4.8 points year on year. And then finally, we have Warsaw to Duisburg. So it remains very volatile in this lane for sure. It's dropped a significant 11.3 points quarter on quarter to 143.3, and it remains at 5.6 points year on year. So generally, it's clear that this spot market and the international spot market is more volatile than the domestic spot markets that we're looking at before. Much more volatile situation. A likely result is if we look on the European scale, we've got those low margins for international carriers and a stagnant European market. So it's varying levels of demand pressure. However, it's being holding and is very sensitive to those low margins that we saw after those large cost increases in previous years. The general market story, if we relate it first of all to the Madrid to Paris lane, we've got to the Lyon to Birmingham, we've got French exports are still quite weak, and we're seeing that Carrefour, for example, seeing a 2.1% fall in their revenue across domestic and international products. So we're seeing there that especially demand from the UK, which is somewhat improving, but is not adding significant pressure to the market. We've covered Germany, but just to cover it once again with that Warsaw to Duisburg lane, of course, we had a minus 0.2% growth, so 0.2% contraction last year in the German economy. That's from the Federal Statistics Office, and they cited elevated costs, reduced exports, and reduced competitiveness as major drivers there. We expect that to largely continue, and the tariffs also brings that possibility in. So we see the potential for continued volatility in that market and the potential for some further falls in terms of that downward pressure. Of course, we do recognize those low margins that will continue the volatility in the market. So look for an outlook in terms of the international spot markets. We're seeing reduced upwards pressure from costs. So we don't expect to see those really high increases that we've seen over the previous few years. But the consumption situation remains rather stagnant, as we've mentioned, and production remains really uncertain. We do have some positives, or rather some growth aspects. So UK demand outlook is somewhat improving, becoming more optimistic. Retail volumes up 1.2% in the first quarter in the household goods, seeing their highest level of growth since April 2021. So there are signs that there could be some upwards pressure, especially on the spot market that we see here. The longer term remains very uncertain, but the spot market could see some increases in the demand side pressure, and which would likely keep this market and these international markets quite volatile. So we could see some falls, but we could also see some increases. So to be open to that, and it's key to keep our eyes open in terms of how we see an actual recovery in this consumption. We will see, but there's potential for some increases here, but continued volatility.
Yeah, volatility definitely apparent on the most recent quarter for that chart, and we'll watch that space very closely for the next quarter as well, particularly import-export lanes, where we try and figure out the effect of tariffs once they actually come into force. And on the theme of outlooks, we're going to look ahead now at our expectations for freight rate development for the next quarter. So I will open up our poll to ask you what you think will happen to rates over the next 3 months. But while you're giving your views, we thought it would be interesting also to show you 2 years worth of data from these polls and explain what the trend has been for your expectations for rates, and a little bit on how that relates also to what actually happened. So Nathan, could you just take us through quickly the trend we saw from the previous polls?
Yeah, sure. So here we're seeing the actual results of these webinars and the answers that we've had from everyone that's involved. And if we look at the x-axis, these quarters are the quarter that you replied in. So then it's at that point, what did you think would happen to rates in the coming 3 months? So if you look at quarter 4, it's what did you think would happen to rates in quarter 1, 2025? And generally see that the general mindset is increasing skepticism around further rate falls over the previous 2 years. So we're seeing that trend carry on through the data set. And actually, we've seen that those expecting some levels of rate falls has decreased from 59.9% in Q2 2023. So the first answers, and it's down to 10.7% in the latest result. So in the previous webinar, only 10.7% of respondents expected some levels of rate falls in the coming 3 months. For Q1 2020, so for the most recent response, the majority of respondents expected some level of rate rise. That was at 59.6%. Expected some level of rate rise, that be slight, moderate, considerate. And actually, the 5.9% expected a significant increase. So generally, there's a feeling that there will be rate rises. The rate rises are going to be smaller. They're not going to be as large as we've seen over the previous few years. They're going to be slight to moderate increases in the coming 3 months.
Yeah, that's great, Nathan. Thank you. Okay, well, we've got our live results now, so I'm going to share those with you. So thanks everybody for participating in the survey. And you should be able to see that now. So, we're following on a theme here of, relatively stable or moderate increases, which I think is in line with the analysis that we've made for this report in this webinar too. But Thomas, what's your take on those results, hot off the press?
Yeah, I mean, first, I think it's the fact that to backtrack it and to have the historical view of this rate sentiment index is quite interesting. This was a suggestion also from your questions from the previous webinar from directly the audience. So I think it's a very good idea. And what we see over there is that if we put the dots for the Q1 2025, will be a bit lower than the one that we see over there, which is quite aligned with what we have put in the report, the outlooks. It's always difficult to think about the global cost with or without the fuel. If we are thinking about the cost of transportation, globally speaking, with the fuel included, I think we will be quite stable because the fuel is decreasing, and the outlook that Marianne was presenting is that the global fuel cost should not skyrocket in the following weeks and months. So if we take that into account, my guess is that we will remain flat. So as 35% of people were saying, it might slightly increase if we don't take that into account. And if we globally think about the cost, the tool increase with the CO2 charges that will increase, and we know that in many countries. So yeah, a balance between slight increase and no change, depending on what we include in the direct cost of transportation, might be something very plausible and a good guess, taking into account that the demand is still quite low, but we have a pressure also from the offer, where between the driver shortage and others parts and the costs that are increasing, the margin for a decrease of prices is quite low.
Yes, absolutely. I think that's a very fair assessment of the situation, really, for the few months ahead. So, thank you very much for your insights, and we'll now move on to our Q&A session. So, thank you all of those people who've asked any questions throughout the webinar. I can see that a few of them have already been answered and tackled as we've gone through the webinar, but we'll deal with as many as we can now. So first one up is from an anonymous attendee, actually. But last month's IU newsletter reported on the general situation of the global truck driver shortage. It said that truck drivers' wages are higher than in other industries and that they have high job satisfaction. So I would like to know in more detail about the current situation in this webinar. And Marianne, I think that's one for you, if you'd like to tackle that.
Yeah, this is a very good question. In fact, what we say that the two main reasons about the truck driver shortage are about the access to the profession on one side and the attractiveness on the other side of the profession. When we say access to the profession, it means not only the cost of the driving license, for example, which is very high in Europe. It is about, in average, 5,000 euros. in EU, and the difficulty to hire foreign drivers, I mentioned it already. But then there is the attractiveness of the profession itself. And here, the top main challenges are, of course, salary is part of it. But what we are seeing that if you take the average salary, to give you an example, globally in Europe, it is about 2,000 euros, which is, depending on the different European countries, by far better than the base cost of living. So what we see when we survey the carriers and also the drivers themselves, this is part of the story. So meaning that the salary is always something to improve, but I would say the top two main reasons behind this low attractiveness is the time which is spent away from home, and even more than away from home is the fact that there is nights that are spent outside of home. So at least one night which is not at home. So this is one main reason. And the other one, which is a big topic also for RU, is the lack of equipped and secure parking areas. This is the main story. Where there are a lot of cargo crimes happening, attacks in different parking, not secured, or even on the side road because there is no parking spaces. So these are the main reasons. And to finish on the perception of the profession, I didn't mention it when I was presenting the driver shortage, but for the first time we have published a barometer of the perception of the profession. So we have surveyed drivers directly in Europe, so more than 1,000 drivers. And indeed, what they say is that they are, most of them, satisfied with the profession. So, which is a very good news. And and men and women are saying the same. So there is no difference. Very interesting. Even women are being more highly satisfied than men. So this is one thing. But the other one, which is explaining a little bit where we are, is that when we are asking the driver, do they recommend the profession to a friend or to someone from the family? So the net promoting score, it is negative. So it means that they are satisfied, notably the young people are satisfied entering the profession. The satisfaction is declining over the years, but they are not at the point to recommend the profession. So this is where we need to continue to work on the two main elements I was mentioning before. I wanted to mention that.
Thanks, Marianne. Yes. Okay. And I can see there's a couple of questions here that Tamar, you'd like to answer about the data in the index and previous restatements and so on. So would you like to answer those
Yes,
questions?
there were many live questions regarding the index, how to read the index, how to compare it with other slides that we have presented previously. So first, the part of the index that is quite tricky is that it's really showing the increase or decrease of the rates compared to the previous dots, the previous point, previous quarter. So having the spot rates or spot index that is below the contract one doesn't mean that the spot rates are in fact below. It just shows that the decrease is steeper and is higher than the one in contract part. And indeed, what you can have, depending on the slides and the timing, you can have new data that are coming in our database, and that might change also the index and the weighted average of the index. This was just let's say, a technical part that I wanted to say. And there was a question on how can I take the historical data between cities pairs or country pairs. For that, you need to come and see us. We'll be happy to show you how to have access to this data directly from the Apply website and Apply the database.
Thanks. Yes. And another question then here asking what are the main factors which influence freight rates, and how have they changed, or have they changed from 2020? Nathan, would you like to tackle that one?
Yeah, sure. I think we've generally seen it change quite a bit every year. And I'm just looking at the benchmark in front of me, so I thought I'd quickly just take us from each year. Starting from 2020. In fact, let's start from 2019. So during 2019, we started to see some there was some increases, but it was largely flat. It was generally quite a weak year for most economies. Look at 2020, initially the first half of 2020, we had big falls, we had COVID, we had a drop off in that short term, and both the short term demand and the long term expectation for demand. So we had lower volume. So that was demand driven. Then as we head into the second half of 2020 and through 2021, we had quite considerable increases in rates. Now, this was also demand driven. So we then had a lot of money around in economies, a lot of kind of COVID money around there. So it's a lot of demand side pressure. We saw rates increase. We then see as we head into 2022, rates really spike and really shoot up. Now, this was a switch from that demand side pressure. I mean, that still existed, but we then had that cost side pressure. So the start of the Ukraine war, we had fewer drivers, we had a significant increase in costs, we started having inflation as well. So that is then costs as we head into 2022. And then let's have a look. As we leave 2022 and head into 2023, we see it drop back down. Now, this was a smaller increase in spiking in costs, but we see that we're now having inflation reducing demand. So then we also have demand being a major factor. We've then seen quite steady through 2023 and 2024. So as we head into 2024, so then we're steady. We see less demand side pressure. We see less cost side pressure. And yeah, so that would explain it. So we now remain elevated. So basically in 2020, we had demand being the major factor. 2021, we had demand being the major factor. 2022, we head into cost. And then in 2023, we had the effect of inflation. So we had demand having the opposite effect again and elevated costs. So I hope that explains it. And now we find ourselves at a combination, reduced cost side pressure, which is more stable. We've got less demand side pressure, increased volatility and smaller changes than we had over the previous few years.
Thanks, Nathan. Yes. Insight there. So a couple maybe more slightly geopolitical questions to end, one of which I'll try and tackle, and then I think the last one looks like one for you, Marianne. So firstly on, do we have any stats about ports, container trucking operation and in relation to tariffs and so on? So I think that's something that we looked at in the report as a sort of assessment of the current situation, but obviously really with the tariffs and Liberation Day coming at the end of Q1, it's really something for us to look at now and ahead for the next quarter. So in the next presentation, we'll be looking at the actual effects of those tariffs as far as we can see them in the weekly and monthly data. We have obviously seen on the Trans-Pacific lane, which is where the tariffs are going to bite most acutely, an initial collapse, I think 6% lower volumes. We obviously wouldn't expect so much of that from Asia to Europe, where most of the volumes are coming in. But it has been quite damaging on the transatlantic lane. But we'll have more to say about that next time around. So please look out for that analysis, and we'll be following that quite closely. But the other question is coming back on one of your points about the Ukraine war, Marianne, and the impact that's had on drivers. And one of our audience has asked, if there's a peace deal in Q2. What impact might that have? And I think it's been answered in text, but it might be interesting for everyone to hear as well. So what do you think the impact of a peace deal and more drivers being able to return to the workforce might be?
Yeah, I think it is going to bring tension on the capacity for sure, because the road freight flows with Ukraine were already very high before 22. So it's the question is going to be more about the capacity or the ability of the operators from Ukraine to cover a big share of those new truck movements. So this is something that we can say at this stage. Also, we don't know exactly if we are going to really follow the same trend of Ukrainian drivers also working in the different countries I was mentioning in Poland. So will we come back to the same share or to the same dynamic? This is a question that we are wondering today. We don't think that we can really say we are going to come back to the situation before the war. So this is what I can say at this stage. And just before I stop here, because there was a question, just to be brief on that, on China to Europe road freight, if there are any statistics, just to mention on that we have starting to collect quite good statistic on this corridor, because IRU is we are if you want, developing TRR, so the transit, the international transit tool, which is allowing the transit countries without having the different formalities to be done at the borders. And the TR is strongly developing between China and Europe, notably performed by Chinese operators going until Europe, so notably Germany and Poland. So in this context and dynamic, which is clearly increasing, more than rail, at this stage, in terms of, I would say, volume, we are having statistics and analysis, and we are going to produce one specific analysis on those on this region at the end of the year.
Wow, that'll be very interesting to see. So we'll watch that very closely. All right. Well, thanks very much to Marianne, Nathan, and Tamar for all your views and answers to those questions today. And thanks very much to all of you for joining us for this session once again. If you want to carry on the conversation, we'll be very happy to hear from you. So please do feel free to get in touch with TI Apply or IU to discuss any issues or questions or data requests you may have. Happy to hear from you. And yes, thanks very much for joining us today, and we'll see you next time. Bye-bye.